All right. Well, we're going to go ahead and get started. Good morning, everyone. Thank you for joining us. This is a busy time of year, I know, particularly for employers who are well entrenched in the beginnings of year end and health insurance renewals. And so we appreciate you taking the time this morning to spend some time with us and learn about some new and innovative developments in the area of cost containment when it comes to health insurance. My name is Joanna Morrow. I'm with Employer Benefits and Advice, Principal and Owner. And this morning, I'm pleased to have with me representative from Imagine 360, Andrew Oram. And we're going to go through the topic. We're respectful of your time, and we're going to be going through it at a fairly good pace. And then we'd like to leave as much as 20 minutes at the end for questions and commentary. So with that, we will go ahead and get started. So just as an outline of this morning's presentation, we're going to make a brief introduction so you learn a little bit about me and a little bit about Andrew. Quick overview of what is the biggest problem out there in American healthcare with respect to costs, what's driving that problem, and then what we see as being the second problem, an overview of reference-based pricing as a solution, 10 keys for successful implementation, and then next steps for those employers who want to learn even more about it and specifically how it relates to a solution for their specific organization. My name is Joanna Morrow. I am the Principal of Employer Benefits and Advice. I hate to say it, but I've been in the employee benefits industry for 30 plus years now, always servicing the employer side of the business. I've been at workers' compensation and then with a large commercial group carrier for 10 plus years, doing group insurance for large employers. And 15 years ago, left the corporate world to cross over to the broker consultant side of the business, where I started my own practice. And now I specialize in all facets of employee benefits, benefits administration. Our firm deals in alternate funding strategies for employers, ASO, reference-based pricing, as well as Ben admin, compliance, and benchmarking. We're one of the few independent firms left out there. A lot of my competitors have sold to private equity, and we're pleased to be able to promote independent ownership and the fact that we are local here to Arizona, but licensed in other states. With me this morning, I'm pleased to have Andrew Oram, Director of Business Development at Imagine 360. Andrew is a forward-thinking, innovative health plan solution specialist, and his company, Imagine 360, specializes in ASO, self-funding, reference-based pricing, and they partner with firms like mine to bring best-in-class solutions to their employer clients. Andrew graduated cum laude from the University of Massachusetts, was a broker consultant himself over on the dark side for over 10 years, and has over 20 years of business development experience working with benefit clients throughout the Southwestern U.S. All right, so let's go ahead and jump in to what we perceive to be problem number one, driving the cost of care in the United States, and that's the hospitals and facilities billing practices. Not sure if everyone saw it last week, but on September 7th, I believe, the issue of the Wall Street Journal did led with a large story on just the fact that health insurance costs are taking the biggest jump in years. They're expecting to see 6.5% or higher in health plan cost increases across the board. And not to get into the entire article, but I just wanted to review the highlights of that article summarized were that, the hospitals will tell you that it's their labor costs and the demand for costly pharmaceuticals that are driving the cost increase, so diabetes, obesity drugs. The truth is the hospital systems themselves have been winning price increases from insurers in recent years. And normally this would have a domino effect and an impact on employers. it is slowed somewhat just due to the nature of contract negotiations with providers. So a lot of these contracts, when they're established, they're good for 3 to 5 years, 3 being sort of the norm. And then, as they come up for renewal, that's when the hospitals make their play for more money. A good example here in Arizona, if you're an employer or even just a resident in Arizona, as a broker here in town, I am inundated weekly, annually with notices from various health insurance companies, just warning me, they'll scare you all into believing that the end of the world is imminent. They haven't been able to, they've failed negotiations with the local hospital systems, and that, oh, we're here to tell you Honor Health is no longer in network with Blue Cross, or Yavapai Regional Medical Center is no longer in network. And then shortly thereafter, inevitably, the news is shared that hooray, hallelujah, we were able to renew those contracts, and we're all going to live another day. And I mean, Andrew, I know you service the Southwest, but would you agree? I mean, just in the last 18 months, I've had Honor Health, Yavapai Regional Medical Center, Phoenix Children with United, with Aetna. I just think, I'm just a little suspect. I just think it's a bit of a game where, it's just this ongoing to keep you off center that, that the hospitals are really the ones driving they're the driving force here. And I think ultimately the insurers just bow down and give them what they want. Which brings me to our next slide. I'm going to let you speak to this because it went out with the email that I sent out, and I want our webinar participants to understand just the degree that costs are being marked up across the country by inpatient and outpatient facilities. And I'll let you speak to this slide because I know your firm was involved in compiling the data. Tell us what we're looking at here.
Oh, yeah, absolutely. Thanks, Joanna. Just to kind of step back and answer your question there about kind of the hospital negotiated contracts. Keep in mind that, when we're talking about these large insurance carriers, we in the business use the term BUCA, which stands for, Blue Cross, United, Cigna, Aetna. Sometimes you put an H on the end for Humana. And then Kaiser is not really included in that acronym, but on average, they control about 96% of employer contracts. And when they're negotiating, they'll drive, generally speaking, anywhere from a 40 to maybe 55% discount. So what this slide is showing you is the average markup, inpatient and outpatient, that hospitals report to the government. So every hospital that gets reimbursed for Medicare, they need to file, their CFO has to file the reported cost of care to deliver that service. And this is the average markup by state, showing, what are they charging the plan before that discount takes effect. So, if we look at a state like Arizona, 500, almost 600% above their cost is what they're marking up. If you get a 50% discount, it's a 300% markup. That's just the status quo. And you can see how this, what these markups look like in other states.
Right. The next slide is just outpatient only. That looks even worse. 718% in Arizona. I was shocked at Florida. Florida's in excess of 1,000%. And, on this call, predominantly we have Arizona employers. Arizona is one of the top 15 states for egregious hospital markups, correct?
Yeah, you're looking at, the top 15 states that kind of fall into, an area you might say, well, why these 15 states? More densely populated than some of the other states to the north, like in North Dakota or South Dakota. And a lot of these hospitals, they're owned by private equity companies, or they're backed. So, think of a hospital instead of a system for delivering care as a business. And these, PE companies are trying to turn the screw to drive as much profit as possible. And if you look at, and I won't spend too much time on this, but Obamacare, one of the things that came out of it were medical loss ratios. So, an insurance company could really only show a 15% profit. So the bigger the markup is on the hospital side, that the more they can stretch that profit margin. It's a misaligned incentive, the way that the way that insurance carriers partner, if you will, with hospitals. And you as the employer really don't have a seat at the table. You don't have transparency. You don't really know what you're being billed, why you're being billed. And there's a lot of, fraud, waste that's just naturally baked into the system that can't be audited without having transparency.
Right. Which brings us to our second problem, and that is PPO contracts. So, we already sort of dove into it a little bit, but, what I see as being the problem as someone in the industry, and I sit and advise employers, day after day, is that you've got, it's a top-down pricing model whereby the hospital is establishing the inflated price. Your insurance company is coming in as the hero who's going to discount off of that inflated price, say at a rate of 40%. And then we're supposed to cheer, for the final claim cost as a percentage of that inflated price. And I mean, when you look at an example of just say a $75,000 hospital charge, what that translates to in terms of, final claim cost is that's your PPO discount. And I know, as opposed to, may as well just jump right in here, reference-based pricing, I mean, the biggest difference is it's a bottom-up approach to pricing. And I think that is at the crux of what people new to the concept need to understand, is that PPO contracts are, they basically participate in the hospital's top-down, pricing model, where reference-based pricing is bottom-up, where Medicare, what Medicare reimburses for a particular healthcare service or treatment is established as the base price, and then you have an RBP vendor who negotiates a percentage of that. And, the result, obviously, in terms of a claim cost, I've just put together an illustration here. If we go back to that $75,000 hospital charge, in both environments, the PPO is discounting that charge 40%, whereas over on the reference-based pricing side, we're establishing Medicare for that same service, what Medicare would pay for that same service in that same hospital, even by the same provider, is considerably less. And then your RBP vendor comes in and says, we'll pay 140% or 150% of that. So your final claim cost, on one claim could be as much as, in this example, $22,000 plus.
Yeah, I would jump in and I would say, super high level, you have to ask yourself, is it fair to pay for something where you don't know what the price is? And that's the expectation with the American healthcare system is we're going, or you as the employer are going to allow your employees to go get care because they need it, but we're going to allow the hospital to charge whatever they want. And that's the top-down approach that Joanna was talking about there. It's called a charge master, and every hospital has it. It's a pie-in-the-sky price that they determine for every single service or procedure, and then that insurance company comes in and they discount it. So if you're going to go buy a car and you're getting a 50% discount, sounds like a great deal. But if they don't tell you what the car costs and you let the car dealership determine what they're going to charge you, that can be a pretty awful deal. And that's what happens every single day within the, that traditional model. What Joanna's talking about with the reference-based pricing, as I mentioned before, every CFO has to report their cost of care for delivering care at their hospital system. So what a reference-based price pre-pricer or vendor is going to do is they're going to look at that reported cost of care, or they're going to look at what Medicare reimburses, because Medicare is the biggest payer in the US. And then they're going to set metrics based on that, whether it's 40% above Medicare, 20% above Medicare, 12% above reported cost of care. Fair, reasonable, transparent. And that's the bottom-up approach, where you're going to drive significant savings looking at, what does the hospital normally receive for payment? And let's set a metric slightly above that. 99% of the time, that flows through without issue.
Correct. This is another example. I mean, obviously, $75,000 claims don't happen every day, but what is more common is, say, a CT scan. And I know, Andrew, this was one of the Imagine 360 examples that I saw when I was at where I met you and your company at the conference in Atlanta back in May. I've been doing reference-based pricing for years, but was impressed with Imagine 360 and your approach. But I like this example because it shows how a CT scan is treated in a traditional PPO plan versus reference-based pricing. And the thing is, a CT scan, something simple like that, depending on where you have it done, can range anywhere from, I've seen them go as high as $10,000.
Yeah, 100%. If you're getting a CT scan in Las Vegas, for instance, most of the employers there have the health plan in Nevada. And by the way, we track metrics for every single procedure at every single hospital in the US. We tap into Truven, to RAN. We use our own data. We've got, 20 million hours of, or 20 million member hours of data, claims data that we've tracked over the last 15 years. So we know, what is the average cost for each procedure at each one of these hospitals. And in this particular example, this is kind of more the impact on the member. So, let's just say a CT scan where I live here in San Diego. If I go to, Sharp, for instance, they're going to charge about $4,000 for that CT scan. And if I'm on a traditional plan, even if I'm self-funded, I'm getting a network discount of about 50%, which would drive that down to $2,000. Well, John, in this example, he's got a deductible to satisfy. So he has to come out of pocket to pay that. And that could be a significant financial impact on him. We know that a CT scan on average costs about $300 to $350, nationally. So that's what Medicare reimburses. So, in this particular instance, that much lower amount will John will be still responsible on his deductible, because his summary of benefits will be exactly the same as his current plan. But the financial impact on him and his family will be significantly lower. And again, it varies depending on where you are. So as Joanna mentioned, that CT scan could be significantly higher or lower depending on the market you're in. But in this example, we drove the cost down to $150, and that's what John had to pay out of his deductible, rather than 10 times as much under a traditional model.
Right. Let's talk a little bit of just the differences in terms of roles and responsibilities in, and just sort of the plan components of a traditional self-funded plan or partially self-funded next to RBP. So it doesn't look a whole lot different. But there are a couple of nuances. And do you want to speak to those, Andrew, in terms of RBP? Obviously, there's no network with reference-based pricing. And so you're going to have, instead, you're going to partner with a repricing vendor, and they are charged with the task of paying claims based on the percentage of Medicare versus your PPO contract dictating what's paid for claims.
Yeah, 100%. So, the look and the feel to the employee is going to be very similar to a fully insured plan or, a traditional self-funded plan. You're going to have someone that's the plan administrator, so they're responsible for paying claims, for issuing ID cards, member services. So, I have an issue, I need to book an appointment, I need to get a pre-certification. You're going to have the pharmacy benefit manager that's in charge of the formulary. Under a self-funded model, you have a lot more transparency. If you're self-funding through, let's just say Anthem, you're going to use their preferred PBM. If you unbundle, and self-fund, then you can pick and choose between a traditional and a pass-through. And the key differences there, a pass-through is going to give you all the rebates, and coupons that would traditionally be collected by the PBM. We see that, that financial impact could be as much as $50 per employee per month, on a PBM for savings. Stop loss, again, there's a tremendous amount of stop loss carriers out there. If you're under a carrier model, you're going to be using their stop loss. If you unbundle, you can pick and choose between A+ rated stop loss carriers like Sun Life, Berkeley, Berkshire Hathaway. There's 15 other ones I can name that you've never heard of. But each one of these are going to be responsible for kind of that umbrella policy. So they're going to make sure that there's a max liability for the plan and there's a max liability for each employee. And then the big difference between a traditional model and a reference-based pricing model, as Joanna mentioned, is the network. We call it an open network, where an employee can go to any provider that they like. And this is actually an enhancement where, say a provider was only cash basis before, they did not participate in a network. That employee can go to that provider. That provider will call and they'll realize that, we're going to reimburse them, and they can seek care there. So, moving away from the model, the traditional model actually enhances the member experience by allowing them greater access. And then we're not relying on poorly negotiated network discounts anymore. So those are the big differences between a traditional self-funded and an RBP model.
Right. And similarly, I guess the fee components are slightly different with reference-based pricing. So, I'll let you speak to those, but I know repricing vendor fees specifically because it's unique to RBP, that's going to replace your network access fees because there is no network. So I think what's important here, and I'll let you speak to it, but I know with a PEPM, you're paying no matter what you're using as a percentage of billed charges because it's a fixed, it's basically, I just think, and I know in some cases, depending on the size of the group, they typically will do a PEPM, but do you want to speak to, I have my own feelings on why percentage of billed charges is advantageous versus PEPM in certain situations, but I'll let you speak to it.
Yeah, thanks, Joanna. There's probably about 9 different repricers out there, and I will do a little plug for Imagine 360. We were formerly ELAP. We started the idea of reference-based pricing about 15 years ago. And we're very, very much a hybrid in that we'll work with the employer to decide what's best for them, whether they want to do a PEPM or a percentage of billed charges. So we're kind of agnostic in that regard. But the two main differences between a percentage of billed charges and a PEPM is, if you have a group that is, low utilization, you're paying, call it $30 per employee per month, regardless of whether they're seeking care, regardless of if there's claims coming in. And one of the things, the big differentiators between a percentage of billed charges, when you move to that, the RBP vendor is more incentivized to fight for the best deal for that employee, that group, that member, because there's skin in the game there. So, $100,000 claim could get negotiated down to $17,000 because that RBP vendor is kind of, financially involved in the benefit and the welfare of that plan.
Yeah, I mean, they're invested,
They're
and that's what you
invested.
want.
Yeah, and another big
Yeah.
differentiator is, when kind of talking to RBP vendors is, are they going to assume fiduciary responsibility of the plan? Will they become a co-fiduciary and make sure that, if they can't settle a claim, they'll pay out of their own money to settle that claim. So just kind of things to, kind of maybe take note of when having a conversation and evaluating RBP vendors out there.
And I know when I sit with clients and even prospective clients, and we're discussing how to vet some of these vendors, I mean, I think that's where, a good consultant is going to have input into, if you're new to the concept, you don't know what you don't know. And so that fiduciary responsibility is a big one, and shouldn't be overlooked. There should at least be vetted, when you're trying to select a vendor. As far as employer considerations in terms of, what I like about RBP, and certainly a lot of the vendors we've worked with, is that there are, there's plan options. It's not an all or nothing approach. And I think, I've tried to lay out here sort of from most aggressive to sort of most conservative, in terms of, how you want to set this up, especially if you're looking at it for the first time. Obviously, the most aggressive is, where you apply RBP to all claims and you eradicate the network and you just pay, all of your claims using RBP. And I'm just looking here. I'm just trying to move. I've got my image up here. As far as, and that might be, as I said, very aggressive for if you're implementing this at the first time. There are some learning curves for both employer and employee. And so a more cautious approach is to retain, there's a couple different things you can do. You can retain that traditional PPO plan and apply RBP to only your non-network claims. I'm more in favor for, and I'll get into this in a minute, because this was the case study that Imagine 360 brought the CFO out from that trucking firm, which I've got later on here in a couple slides, when we were in Atlanta in May, where they basically retained a traditional PPO plan and offered it next to an RBP plan, and you allow employees to make the choice. And I think that can be a really effective way to introduce RBP, and just sort of get your feet wet versus throwing the baby out with the bathwater and disrupting everybody's health insurance model as they knew it and have known it their entire lives. The hybrid obviously is, a combination of direct provider contracts, and we don't have a lot of those in Arizona, where you've got employers contracting directly with health hospital systems. But, I think it's becoming more prevalent across the country, narrow networks, and, just a combination where you're applying that RBP pricing to just your out-of-network claims. And then I've even seen carve-outs where you're just using that RBP pricing in a self-funded plan when it comes to paying for, your high-ticket items, your conditions and treatments that are going to be, your higher cost items like dialysis. Any input there, Andrew?
Yeah, I would say I think you hit the nail on the head when you were, kind of talking about the second bullet point here, more cautious. What we traditionally see when we work with consultants like yourself is, there is a conversation with HR about, how do I, it's always about attracting and retaining talent, right? So I don't want to take anything away from my employees. Is it possible for me to add something like this onto my plan? And the answer is absolutely. If you're already, let's just say you're self-funded, with Aetna, you can offer a self-funded plan through Aetna and then put a mirrored RBP plan next to it. Oftentimes what we'll see is the CFO and the HR will collaborate and they'll say, well, we know this drives deeper discounts. It's going to help our employees. It's going to help reduce our costs. Let's put a 30% differential in there. Let's make it 30% cheaper from the employees' contributions, from their monthly deductions, so we can incentivize them to go there. Normally, we'll see about a 60-40 split the first year, where 60% will go to the RBP plan and 40% will stay on the self-funded Aetna plan, and then the next year it'll move to maybe an 80-20. The experience, you need those kind of early adopters that first year, those people that either maybe they say, well, I really don't go to the doctors that often, or I actually can't afford this plan, and I need something a little bit more inexpensive. So that number two is under more cautious. That seems to be the norm that we're seeing. And then I will add a little caveat to the most aggressive. RBP used to be RBP on everything, facilities, so hospital claims and physicians. And what we've seen over time as it's developed is there's a network solution normally in place on that physician side. Most RBP vendors are going to offer some sort of network solution, whether it's one that they rent or if it's a proprietary one that they've developed. But what that does, because we know that the majority of costs come from the facility side, but the majority of claims come from the physician side, it actually smooths that whole member experience out on that physician side by having a network in place. So that's two caveats that I'll add to this page here.
All right, I appreciate that. I just want to, in the interest of time, we've got about 20 minutes left. So I just wanted everyone on the call to be cognizant of that. We're going to, this presentation is being recorded, if I failed to mention that at the beginning, and everyone will be sent a copy. We're going to try and leave about 10 to 15 minutes at the end for questions. So with that, we're going to continue on here. And another employer consideration, obviously, is your stop-loss carrier. Even RBP plans are going to have some claims that reach your spec and your egg as far as deductibles. So you want to have a discussion with your stop-loss carrier. Certainly, when we're quoting it, we have stop-loss carriers, preferred partners that we work with who are open to the concept of RBP and are very experienced in it. But you definitely want to consult with your stop-loss carrier to ensure that that they're pro RBP if you're considering it as a strategy. Balance billing. This is a big one. It comes up a lot, and a lot of the time this is why people haven't heard about it, because there are brokers out there that are scared of the potential for balance billing. What I've noticed, Andrew, in the last even 5 years is that there have been huge improvements in terms of mitigating the risk of providers not accepting a Medicare reimbursement. All RBP vendors employ, a great, robust sort of support team, advocates who are charged with, negotiating any balance bills. And a lot of the ones I've worked with have employee communications that specifically state, should you get a bill, do not communicate, do not talk to them, it's to come to us, and we do all the heavy lifting. And, everything I've worked with, that's the last I've heard of it, it gets dealt with. And so I know that the concern is that there's a very small percentage, that go to court. And I think what's important there, if you're considering this option, is that, based on our research in this firm, and we look at, what industry professionals are saying, what case law has dictated, is that courts are starting to rule that, anything north of 200% of Medicare is just no longer, it's very difficult for healthcare providers to argue that it's fair and reasonable, particularly when you're already accepting, Medicare reimbursement for the exact same service in the exact same hospital by the exact same provider. There was case law out of New York back in 2014 where the court held that a self-funded plan was not that was using RBP was not violating its fiduciary duty by using RBP, and the court ruled in favor of the RBP plan and the health plan itself. And Andrew, I think there was one case that this Denver case, was this an Imagine 360 case? This one out of Colorado?
Yeah, I think you're referencing the French versus Insurer case where we defended one of our members all the way to the Supreme Court of Colorado, where the decision ruled in favor of our member. I think originally, you can Google Censura versus French, but the hospital was trying to balance bill her for about $250,000. We deployed our own resources. That's part of part of the value proposition working with Imagine 360. And at the end of the day, she was responsible, I think, for about $875, just whatever was defined in her EOB. So what we're finding more and more is it's harder for these hospitals to justify, these 500-600% markups when they're accepting, Medicare reimbursement.
Right. Sort of as an aside, certainly not this is just proof again of just overbilling and courts ruling in favor of the patient. We had a case here in Arizona where Cigna actually settled a class action lawsuit here recently where they were overcharging for lab services, and there was an Arizona plaintiff, that had an experience with one of their labs here in Arizona, and the amount billed, believe it or not, was in excess of $17,000 when the cash price for an uninsured customer charged by LabCorp was, allegedly only $449. And that ruling just came out. So you and I appreciate this because we're in the industry and we're behind the scenes and we see this kind of stuff and we know it goes on. And so I'm always, as a broker consultant, looking for ways to just strip away the convolution and, the non-transparency both for employees and employers, because the presence of it makes yours and my life so difficult, because the employer can be adding or offering a really good plan, but the perception by the employee when they have an experience like this is that they're alone in the deep end, and it diminishes the value of employee benefits, which is, flies in the face of the whole reason an employer offers it in the first place. I think what's important to note also is that I feel, and I'll let you speak to this also, but I feel like never before has there been a favorable environment from a federal sort of legislative standpoint in terms of just, looking to protect the consumer with respect to cost control. You've got the Patient and Protection Affordable Care Act, Obamacare. It created a favorable environment for RBP strategies. You've got the DOL saying that, RBP is compliant with ERISA and other applicable regulations. And then you've got the court decisions themselves, which continue to come down every day, where you've got, an acknowledgement by the judicial system that RBP is lawful and it can't be argued it's an effective cost containment strategy. Employer testimonials. So we know there's big mammoth employers offering this. I've had small cases here in Arizona that are level funded that where we've offered an RBP plan, and that's how I first, was introduced to it back probably 6-7 years ago now, and became a proponent of it. I'd like to write more of it in Arizona because I really believe it's the way of the future. You've got the state of Montana, you've got Purdue University, Rosen Hotels and Resorts, City of Kirkland, Washington, and I apologize, that fifth one should be highlighted in red too, but MV Transportation is a large trucking company out of Dallas, Texas, and I was introduced to them through Imagine 360 at the conference in Atlanta in May. And for those of you on the call, Imagine 360 was one of the breakout sessions, and they had the Director of Compensation and Benefits there with them of this trucking firm as their guest. And he was a real live case study who shared his experience transitioning to Imagine 360 and their RBP product. And, one of the things the bottom line was, I think the gist, and I'll let you fill in the gaps here, Andrew, but I mean, the gist was they were exceeding their benefits budget by $6.5 million a year, and were looking for a way to stabilize healthcare costs going forward. And so Scott Baker, who was the director of compensation and benefits, he started poking around and learned about reference-based pricing through his broker, and through an entire vetting process. Imagine 360, emerged as the successful provider, the preferred provider that they chose to go with. They had both union and non-union employees, and made the decision to offer the non-union employees a choice between a traditional PPO and your Imagine 360 open access RBP plan. And I could be off on the numbers here, but the combination of both initiatives yielded, I think it was a savings of, they were like $2 million under budget. And that was in 1 year, saved like almost $5.5 million compared to the prior year. And the savings were so, significant that the second year, the union came knocking and was interested in implementing RBP or offering it as an option to their members also. So it reduced their, I wrote this down here, the per employee per year spend reduced from $11,470 to $6,600. I mean, I was just so pumped when I came out of that session because, and even in that session, I mean, there were brokers there from all over the country, and I could tell the room was divided. There were a lot that were just, it's new, I don't understand it, but I really think we owe it to our clients as consultants that if we're not willing to sort of put ourselves out there and embrace these new strategies and innovative products, what good are we? That's my soapbox.
Yeah, that's great, Joanna. And I'm not sure I can add much more to that case study. I can tell you if you go to our website, there are case studies on there. Just kind of a rule of thumb, if you look at a traditional self-funded model where you're tapping into a network and you're getting a 55% discount, we're on average driving about a 67% discount if you look nationally, and that that 12% or more makes a significant impact on a health plan, and that's that's setting aside discounts that can be realized through carving out PBM. So it's not surprising, and I'm working with companies every single day where we're seeing millions of dollars in savings just because of the fraud, waste, and abuse that's built into these plans. That relationship between the traditional insurance carrier and the facility. When you strip all that out, really what that means is more resources for that organization to deploy in the manner they see fit to run their business. And that's what happened with MV Transportation.
Right. No, it was a great success story. So wrapping up, I want to leave everyone with just sort of, what the 10 keys for successful implementation are. And obviously our hope is that for those that are interested and want to explore this further, I mean, obviously this is a fairly generic presentation. There's a lot of intricacies and moving parts specific to your company, your health plan, and we'd certainly welcome the opportunity to have an appointment and, delve into that deeper. But at a very high level, you want a robust and dedicated HR team, and certainly your broker, your TPA, and your repricing vendor are there to really collaborate with that team and make it strong, because it's a new strategy. There's communication demands and responding to employee inquiries, and that's certainly where we feel we add a lot of value. You want a robust stop-loss contract, and I apologize that UMR and Blue Cross Blue Shield, I believe when I was doing this presentation, I had a distraction there. I got a call, and it ended up in the slide. So Yeah, Blue Cross Blue Shield is not interested in doing reference-based pricing. So I'll put that caveat in there. So disregard. You do want a trailblazing leader. This is not for the faint of heart. It is a new concept. And, that fellow that we just referenced with MV Transport, I mean, he was a relatively new CFO, and he had been hired, to replace someone who was not getting the job done. And he was basically given full reign to just, do whatever he had to do to get them within budget. And that's kind of the mentality you need, I think, when you go down this road. You want masters of effective communication, and that's really where TPAs and brokers can really support. Obviously a lion-hearted broker. What does that mean? I think you want someone who, who mimics maybe that trailblazing sort of leadership mentality that you've got at the company, that isn't afraid. It's like anything, somebody's got to go first. And you want someone who's got the courage and the know-how and the expertise to really hold your hand and guide you through the process, educate you on, some things, speed bumps that you might hit along the way. But at the end of the day, I think we can all agree on this call. What we're doing right now is not sustainable. The hospitals are just continuing to gouge everyone, and they're getting more and more difficult to satiate with these PPO contracts. And at some point, you have to, employers have primarily been the ones to sort of change the course of the ship in this country. And I have every faith that we can do it with healthcare spending with RBP. You want an ideal TPA. I'm a big fan of Imagine 360, and I was impressed with them. They were not the only ones at the conference I attended, and I've used others in the past, but do you want to add something here, Andrew, with respect to, what to look for in a TPA?
Yeah, I mean, I guess questions you might want to ask yourself when evaluating a reference price vendor is, are they integrated? Meaning, when my employee goes, to get care and someone has to verify coverage, is there someone on the other line that understands the plan when there's an issue? Is it just going to be one call, kind of ends all? That's very important on the member service side. On the balance bill support, is there a strategy in place? Is the organization that you're working with, are they using AI? Are they tracking the revenue management cycle? Meaning, do they know where hospitals have settled bills in the past? Are they getting ahead of that when they're paying bills, pre-negotiating so that they can settle those claims while not diluting, the plan assets? So all of these things are very important. I would encourage you to, talk to references. How long has that company been doing reference-based pricing? Do they have credible clients? I can speak for our organization. We have clients that are, 50 employees and then over 10,000 employees. I think all these things are important. Touching on that stop loss point, is the RBP vendor you're working with, are they negotiating to make sure that you're getting RBP credits from your stop loss vendor? Since we're driving down the actual cost of the claims, the stop loss should be less expensive. Is that vendor helping you negotiate better stop loss contracts on the front end? Are they flexible? Do they own their own TPAs? Are they outsourcing TPAs? Do they integrate with PBM vendors? There's a lot of moving parts here. So you just want to make sure that the RBP consultant you're working with has a good grip on how this whole program is coming together. And then again, are they assuming fiduciary responsibility? If I haven't made this point before, I can tell you in the history of our organization, we've never had a member that has paid more than what was defined in their explanation of benefits. And that's important. Is the RBP vendor going to step up? If that person leaves the organization, if the organization leaves that RBP vendor, Are they just going to
Right.
drop everything in their lap, or are they going to continue to negotiate and settle that claim, regardless of if that RBP vendor is still profiting from that relationship? So again, in my mind, this is about transparency. It's about accountability. And I would be asking all of these questions on the front end, when interviewing, an RBP.
Well, and I think this is certainly where your broker consultant needs to step up, and that's really our job, is to flush a lot of this stuff out, to make that. I'm all about my clients making informed decisions, and I don't ever want them to come back and say, well, I didn't understand that, or, I didn't realize, rebates weren't being passed through to us, or whatever it is. So I think whether it's a perfect repricing partner, legal support within that repricing partner, and balanced bill support are all things that really, separate the men from the boys when it comes to just who your preferred vendors are. And that's really a good consultant can help set your mind at ease that you're working with all the right parties.
Yep, great point. Does your broker, understand RBP? Do they have they written RBP business in the past? I mean, the great points there, Joanna. You want to work with a consultant that really understands, what they're doing in this space.
Yeah. Last but not least, and I've got a few little items here that I can show or share. One of the first RBP cases I wrote that shows just the nature of the employee communication. But obviously, my contact information is there. Andrew's contact information is there. We'd love to sit down with employers personally and privately and just sort of delve into, and if you want to run a quote, we can do that and would welcome the opportunity to do that. I think it's important to know the haters are typically going to be your BUCAs. It's going to be Blue Cross, United, Cigna, Aetna. When you see stuff on the internet about, that's derogatory or negative about reference-based pricing, it's typically coming from one of the insurance companies or one of the hospital associations. So it's important to consider the source when you're discussing reference-based pricing in mixed company. In our opinion, reference-based pricing has gained significant momentum. It's obviously every organization is different, so we hope that this topic has piqued your interest. We offer complimentary review, analysis, and recommendations at no cost, and for no requirement to switch to my firm as a broker. And I think that's important. We're so passionate about ensuring that our clients and employers can make sophisticated decisions and make sophisticated buyers of all of you. And we just hang our hat that at some point, if we're offering value and offering that kind of support, we may earn your business. So that analysis has allowed us in the past to look at contracts for employers who are not clients and identify where there's significant fat and make recommendations as to changes they could make to trim that considerably. And so we offer that if you decide, well, I'm not interested in reference-based pricing, but I'm not convinced I'm getting the best deals that are out there, whether it be stop loss, your PBM, whatever the case may be. With that, I'm going to turn it over to our moderator and just check, are there any questions for us, Lynn, with respect to this presentation?
So we do have a few questions. If you have time to answer several of them, you let me know.
Yeah, we did get a late start. We waited for people to jump on the call, so I think realistically we have about 5 minutes.
Okay, sure. So Sandra does have a question here. She says, what percentage of companies are using reference-based pricing? And if it works so well, why don't more companies use this strategy if it's working so great?
Joanna, do you want me to handle that one?
Yeah, go ahead.
Sure. So, if we look at all employer health plans, we have probably about 4% of employers that use reference-based pricing as a strategy. About 60% of employer plans are self-funded. And I guess the second part of that question is, why haven't more moved in this direction? There's a huge financial incentive for, the BUCAs, to keep people on a traditional negotiated plan. And there's a lot of fear in the market space. So, kind of going back, if you look at 50 years ago, the average spend for GDP on healthcare spending was about 7%. In the last 50 years, that's risen to 20%. So 1/5 of our economy. All of those large carriers tied to that, if you look at their stock prices, they're all publicly traded companies. They've gone up, 400, 800, 1,000%. So there's a huge financial incentive to scare employers into the status quo. So that seems to be the biggest hurdle, kind of moving from a traditional model to an RBP model. And one of the reasons why I think it's good to put these plans side by side as a stepping stone to alleviate some of those fears of HR and maybe members themselves.
Yeah, and I would agree with that. I think just as a broker, even within my own community of professionals, they're it's like any profession. You've got your sort of your renegades and your trailblazers, and then you've got those that are going to be more conservative and for obvious reasons. But I think like anything, I've always been. It makes sense to me, and I've had firsthand experience early on, so I know it works. And so I'm passionate about it. And I think just because you haven't heard about it or no one's talking about it doesn't mean it can't be an effective solution for you.
Agreed.
Lynn?
Well, that segues perfectly into our next question, which comes from Tom. So can you talk a little bit about the origins of reference-based pricing and why haven't I heard about it before?
It's interesting because we, at Imagine 360, we like to tout that we were the innovators of reference-based pricing. Our original organization was called ELAP, and we were just a repricer that started in 2007. Steve Kelly and Woody Waters were the founders of the idea in the U.S. And they were on the property and casualty side, working with a company called Langdale Industries. And they were doing such a good job negotiating down the claims that the company said, well, can you do this on the benefit side? And they said, well, I don't see why not. So they partnered with the TPA and really started that concept of reference-based pricing. And since then, it's grown into, some mergers that we've had where we've become an integrated healthcare solution with stop loss, with TPA, with pharmacy partners. But RBP didn't start in the U.S. It actually started in the 90s in the Netherlands. They were using cost containment solutions for pharmaceutical products. And then in Germany, they expanded it and started using it for medical devices and hospital cares. And fast forward, you see in 2011, CalPERS started using it for hip and knee replacement. Walmart in 2012 used RBP for spine surgeries and heart surgeries. And then CMS started using it in 2013 as a pilot program for joint replacement surgeries. 2015, Lowe's started using it for non-emergency procedures. So even though you may not have heard of it, it's actually a strategy that's been implemented by countries and by some of the largest organizations in the U.S. We're talking, Walmart, for instance, huge employer that doesn't really need to buy any kind of insurance. They just they self-fund everything and they negotiate claims, using RBP. So even though the majority of us haven't heard of it, it is a strategy that's been, employed for, nearly 30 years now.
Thanks, Andrew. And thank you, Lynn. I think if there are, in the interest of time, if there are additional questions left, let's table those and we will reach out to those people with our response, just to be respectful of everyone's time. really quickly, the first RBP case I wrote was a level funded case here in Arizona, and the TPA was Trustmark. And I just want to give everyone on the call just an idea of the types of communication that you can expect from your TPA, from your broker, that are going to explain to employees, what's different and how to, this is 3 important things to know about your benefit plan. There is no network. How much do I owe? What your ID card will look like. So this specifies right on the ID card that this doesn't utilize a PPO network, that it's, it pays a reasonable fee. There is a FAQ that goes out with the ID cards that just answers all of their questions. It tells them, that Medicare is used as the basis point for reimbursement, how to submit a balanced bill. So, this is from 2017. I wrote this case. So this has been around a long time. We've been doing this for a while. And I really want, I'm interested in just getting more employers to buy into the concept, because I really think it's the way of the future. With that, I'd like to thank everyone on the call, and we will be sure to get that copy of the presentation out to you today. If you have questions or you wish to speak further on it, our contact information is there. And with that, thank you, Andrew, for participating, and Lynn, to our moderator, for fielding the questions. And I thank you very much.
Thanks, everyone.